Welcome, everybody. Welcome to the Artificial Intelligence Transform podcast with myself, Tim Hughes, and with Ed Fowler.
Hi, folks. Ed Fowler here.
So what are we talking about this week, Ed? Financial services?
Yeah, it's quite a complicated one. We're going to talk about...
Surely we just go down the bank in the high street, don't we?
Pretty much. It's which intelligence we use. We're going to talk about the impact of AI on financial services. And we're going to stretch it from what we've been talking about a lot, which has been kind of generative AI, the chat GPTs of the world. We're going to stretch it towards something called AGI, or artificial general intelligence. And the definition is a bit that sort of chat GPT is a generative AI. It's kind of a stochastic parrot. You give it some input, it predicts what the outcome is. AGI is providing that with tools and mirrors that basically means it can start doing stuff beyond just generating text or images. So, for example, you can tell it to make a game and it would go and buy the relevant software development lifecycle elements, maybe buy some cloud time automatically, and for various levels of quality.
So you reckon OpenAI have got one, but they're not releasing it yet?
Yes. So Project Lazarus is apparently the scuttlebutt around OpenAI. Which apparently displays most of the attributes of an artificial general intelligence, but apparently is stunningly inefficient computationally. So the word that's going around is that OpenAI are polishing $100 billion rock. And the idea being is they're getting something really quite impressive to go together. And actually you can see that in the latest versions of the paid subscription to ChatGPT, it comes with plugins to things like its image generation, DALL-E, comes with vision, it comes with speech analysis, it comes with artificial, or rather I should say advanced analytics capability. So for example, you can upload a spreadsheet and it will tell you what's in it. It hasn't chained those capabilities together. They're all separate. So you manually have to bridge them over. But you can actually tailor them together with a bit of tinkering around the API use and actually produce something that's pretty compelling. It will do an awful lot of use cases by itself. And this is an important step, which changes from generative AI being a bit of a toy to a degree. It being something that's fun and great and really useful, but isn't going to be life-shattering, into something that the guys in banking are talking about as the great transformation or the great transition into a previous state, which was human-dominated or IT augmented business processes, to something that might look very much the other way around, that it's human augmented IT dominated banking. And to a degree, most banks and financial services are already very highly automated. They're already very strong investors in IT. There are some statistics that suggest that to give everybody in Britain the same capabilities we have now, and we take for granted with banking, but with 1970s technology, would require 40 million workers. It's that kind of productivity increase of 100 to 1. And they're talking about this could happen again. So we're going to talk about some of the impacts on this one. I mean, I think the first one to talk about is some pretty profound implications this could have. Most of the financial services that are away from retail, so as in sort of me and you just moving money around the places, paying bills, maybe doing investments, the banks make an awful lot of money. When I say the banks, I mean things like investment banks, etc., and trading banks make an awful lot of money by basically exploiting inefficiencies in what was called the efficient markets hypothesis. Ergo, $1 in New York is slightly cheaper than $1 in London. So if I can spot that quickly, I can trade really fast between the two. So you've seen a lot of investments in things like very rapid trading. People are buying their own fiber and satellite links so they can trade by microseconds faster. AGI with a certain level of processing capability and fidelity can actually start removing large numbers of those efficiencies very rapidly indeed, which means that there are some fundamental changes coming to what's called the casino, which is essentially the speculative elements of banking, where they use money at rest, either through treasury operations or overnight trading to make additional money. And that's something that could get wiped out. There's also another interesting one, is that the portfolio management, which is used by, say, wealth and asset managers to keep baskets of assets that they may use in different ways, will radically change. At the moment, portfolio management is closer to art than science. Its ability to track is very notional. Some private equity companies, some wealth managers have very good returns over periods, but the long-term trend isn't actually that much better than standard market return. AGI might alter that by taking on much larger and more granular baskets of assets. So if you think about in these wealth managers, probably the lowest level asset they would buy is a domestic house. So if you'd say like $500,000 a chunk, because they can't really manage them any lower than that. What you could be seeing is actually very rapidly that somebody comes along and starts building machines that have got the ability to manage assets down into the hundreds of pounds. And this could be things like chunks of pseudocurrency. So, for example, your nectar points. This could be individual parking slots on a day rate basis. And that would have opportunities for you as a consumer to contribute into that. Because obviously, if the big banks have got these AGIs, you will soon have them in your phone. So this banker in your phone will enable you to get through. But that ability to effectively look at behavioral capability, asset worths, and a more sort of arbitrage basis is going to change some of the underpinning financial models, which an awful lot of banking depends upon. You're also going to look at some of the advisory capabilities. There's an awful lot of people that are like independent financial advisors who make a handsome living and basically give wealth advice to people about their pensions. That could also rapidly change as well. I mean, the first high street bank that launches an IFA based on AGI is going to eat the market, because everyone will go, well, why am I paying £200-300 a cycle to this independent advisor when I can get just the same quality of advice for free? Which means that if there are independent advisors, they're going to have to step their game up. There's an awful lot of industries in there that have kept along for pretty much noddy knowledge, and that's going to be challenged pretty much rapidly. So there's going to be some interesting insights in that one. I think you've seen a few articles coming out, particularly Forbes have started to talk about this. And again, the key phrase to look for is this: the great transition, where they're expecting either a massive headcount haircut across financial services, which has got implications for not just financial services, but for the countries they service, but also potentially a vast spreading of financial capability out towards consumers. Because then there's tools at the moment we don't use as a sort of an individual person because your portfolio isn't big enough. It doesn't make any sense. Those tools will very rapidly come through. And that kind of leads on to the next area where we're going to see is a change in effectively how financial services are operated. At the moment, despite much of their commentary, banks and finance houses are not really customer centric. They're product centric. They talk about products, they're very siloed products. I'm going to talk to you about mortgages. I'm going to talk to you about guaranteed lending. I'm going to talk to you about unsecured lending. I'm going to talk to you about leasing things and stuff like that. Essentially, they're different classes of debt and risk, which they attach to different classes of assets because that's how they're managed. Now, that's going to change very, very rapidly. The first cycle you're going to get to is called hyper-personalization of experience. If I or you go to the same bank, Tim, why is our experience mostly the same? That's going to very rapidly do it. Once they build this effectively, what's called the back end to the front end type conversation, the front end can very rapidly be starting building by pretty much the generative AIs we have right now. We're talking Gen 1 generative AIs. Can start adapting that based on principles so that the journeys become more fluid, they become more conversational. The presence of like a conversational AI to guide you through things that can do stuff will be there. But what's going to happen very rapidly behind that is you're not going to just get personalized experiences, you're going to get personalized products. And at the moment, that'll look like effectively a comprehensive financial planner. They'll start offering mini IFA capabilities that'll stitch together your portfolio. But as these back-end products become more and more granular, as the tool sets that manage banking portfolios move into much more granular capabilities and more far-reaching model, they're going to be able to offer that to you. So it could be that the fact is that your real-time banker in your sort of banking app starts talking to you about, well, actually, it's coming up to Derby Day. We could buy some car parking spaces in advance. Would that be a risk-free something? And in fact, to a level, they could start saying, actually, this was in your risk tolerance that you would set up when you have the initial setup. And I just did it anyway. And the machine could just do it and start acting with a degree of authority. And that means it could stitch out and reach out to people and start saying, well, is there a resale capability? Can I buy this? Can I sell this, etc.? And how fast can I return money back to you? And that's going to start coming along further. So the phrase again to look for in the articles you're looking for, and there were some great ones in some of the blogs around this, is the banker in your wallet. The idea is that you will have a full service banking capability in your wallet within less than 5 years. And that means that the current banking apps are going to explode in complexity across this.
And I guess we could be using our banking app just as much as we go into Facebook every day or something.
Well,
like that.
That's the point, is you start getting this. I know there's been this long-term thing, and to a degree, that was why Elon Musk bought Twitter, as this sort of omniversal app that was start doing it. And it's probably the wrong approach, because people don't really need to have that sort of parasocial conversation. However, everybody needs to understand what their money's doing. And if you have a banker in your wallet that can be showing you opportunities and indeed asking you questions much more rapidly than before, that's going to hugely change how often you're interacting with that bank. And the more you interact with it, the more data you give it, the greater fidelity of the response. Now, that's got two sort of ways. One, you could obviously get much more inclusive, user-friendly finance that makes us all wealthy and puts more dollars returned to human beings. There's going to be a heck of a lot of privacy controls on this, because the data that needs to work with is vast.
But I can hear people in financial services saying this won't happen because we're regulated.
And that's the regulators are going to have to take quite a careful response. We've always been spoken about this heavy-handed sort of pseudo-European method of doing it, where everything must be regulated to death, and a lighter touch principles and risk-based model, which has typically been what the sort of more Anglo-Saxon world of Britain, America, etc., has adopted. That balance is going to have to be really tightly made, because if it goes wrong, you get either complete death, and we'll talk about why that's going to be quite interesting later on, or you get something that's a bit of a Wild West free-for-all. Now, traditionally, certainly English law has applied more to a degree of caveat emptor. If you play in the marketplace, it's your responsibility to educate yourself and understand the risks. That education step is more of this, let's face it, insane complexity we have of financial services, of risk and arbitrage and futures planning and a degree of speculation, gets somehow packaged down to a retail product. Where's the risk being? Is it the foundational models that they're buying? So is this risk being offset by a Microsoft or a Google? And indeed, what are you giving them in return? Or is this something that you have to take effectively an eyes open approach on as you sign up for this? And that's something we're going to see very, very rapidly. And we're going to talk about the governance of this thing, because we start sliding into the alarmist territory with the capabilities of AGI. One of the feedback loops that you could imagine an AGI to do is it starts bootstrapping itself to get more intelligent. So if you imagine you somehow OpenAI creates this thing that I can buy, and I give it a couple of £100 and go, make more money and make yourself smarter to make more money. There's effectively the principles you could give it, and then see what it does. You could imagine this dystopian future that it suddenly hoovers up all of the spare capital in the world. And I think there's been an awful lot of fiction about that. But there is certain limiters that are going to be in place around these things. One is the cost isn't going to be minimal for these things. These are stunningly inefficient computational engines. They're very generic, but they're not efficient.
But if we're all doing it,
then the cost is still going to go through, because there's only so much computational power kicking around the place. I mean, cloud stuff isn't cheap at the moment, Tim, and it's just going to get more expensive if we're hoovering up all of this. But I think it's quite important that we start thinking about that balance between effectively a very locked-down governance model driven by fear, and a more informed governance model which is driven by the fact that no, this stuff has limitations. You can't get infinite processing power out of these things. Many of the use cases are very much driven by how much horsepower and which available data you're going to get. This is just going to be a better now, but there will be a degree of arms race. I think you have to effectively liberalize some of the governance to stay in the running, because this pace of change is going to pick up. And I think one of the things we can talk about is the sort of geography of finance. If you look at like a city of London or New York, those markets were there primarily because originally that's where the dealing happened. I mean, the London Stock Exchange and the Amsterdam Stock Exchange came out of coffee houses where people would meet to have coffee, and they would do a deal. And then they got too big for the back rooms and above rooms of these coffee houses, so they started renting spaces out, and suddenly you have a Royal Exchange that becomes the stock exchange. After that sort of we need to physically be in the room to do trading time model, and we've invested enough IT to make that go away, what's actually happened is that the markets have now stayed where they are primarily because of talent, because the talent is here. People like living in London, they like living in New York. One of the reasons that, shall we say, the trade hasn't flown as much away from London to Frankfurt is fewer people like living in Frankfurt than they do in London. It's a straight matter of fact. So governments have had an ability to control that to a degree by effectively saying, we will create talent, we will create stable taxation and property laws, and talent likes that. We will invest in arts and culture. So the talent is there, and therefore the money follows the talent. As we start moving into a sort of an AGI, post-AGI finance world, those don't necessarily happen. because now the market isn't going to be dominated by talent, because to a degree, a huge chunk of that form of talent is being done by the AI.
Yeah.
It's going to flow to the lowest regulatory barrier. And money is very, very quick at moving. So you could then say, well, I'm going to set all of this up in the Seychelles straight away. I'm going to set it all up in Singapore or wherever. And suddenly I don't need to find 500,000 bankers in that place. I can find the relevant engineers on a global level, but the money is being now traded wherever I can effectively create that regulatory environment. So those highly liberal regulatory environments are going to be something that governments are going to watch out for, and it's going to have to take some meta-government coordination to stop that. There will always be regulatory differences driven by primary cultural concerns, the concerns of the electorate, and the concerns of the regulators, of course, and their insight. But one of those ones, they're going to have to move pretty rapidly, because if you start setting some of these latest tool sets and some investment, the next sort of large financial challenge won't be blockchain and these sort of models that were hired offshore. It'll be all finance on earth just moves to one place. And that's where you can do all the business. So that's something that's going to be different. But I think we're sort of going to come into the sort of final areas of our sort of 20 minutes. We're talking about, where does this leave humanity? Now, you would kind of think in this post-AGI world that money is pretty deterministic. And therefore, if we look at the sort of types of reasoning that an AI can do, which is kind of, and I'm not assuming generative AI, I'm talking the wider AI of analytics and harder mathematics than statistics. Not that statistics isn't hard maths. They tend to focus on deductive reasoning. You build systems, even with AIs in them, that go, if then that. They're really the proper assumptions of data is correct. Causality tells us that those conditions are that true, therefore the output's that. And to a degree, AI systems are quite good at something called inductive reasoning, which is where you can express it out to like a case. It's not just if then that, but it's always if and always that. Therefore, it will always be the other. The bit that these systems are not very good at, which humanity appears to be uniquely good at the moment, is something called abductive reasoning. And abductive reasoning is where you base it on a series of assumptions and then move forward because it's good enough. And for example, I look out the window, the grass is wet. Must have rained. That is abductive reasoning. And a computer finds that extremely difficult to do because it isn't deterministic mathematics. And it's not statistical. You're not balancing probabilities on this one. What it actually is a branch of set mathematics. And set mathematics, binary systems, and even quantum systems find it notoriously difficult to handle. They cannot do it. Now, this abductive reasoning could be, obviously the sort of philosophers and mathematicians haven't got to the bottom of it yet, could be the core of things like imagination and those sort of wild leaps where you take an educated guess. You haven't got all the data. And it's a way of balancing assumption sets. Now, that partnership with the Brits that, frankly, human beings don't find particularly good. Human beings, despite the sort of Sherlock Holmes things of the world, are not very good at deductive reasoning.
No.
Really not, because our assumptions base isn't particularly accurate. We can't test them very rapidly. And inductive reasoning, I think both computers and humanity are sort of okay at, but not brilliant. This abductive reasoning, backed by a very powerful statistical analysis and deductive reasoning capability, is synergistic. You can start getting some very imaginative product ratings. But I think the final thing that's there is these systems have no empathy. And
yes,
they're pitiless.
Well, there's a lot of humans that don't have any empathy as well.
There are, but you can educate empathy into a human being. Or if you can find the ones that
slap
it around a bit. But I think it's actually an important point that the most effective leaders and most effective artists and philosophers had a very, very strong sense of empathy. They understand the complexity level, which cannot be measured effectively. Now, empathy on a sort of a bleak level is an understanding and positional set. It's a form of abductive reasoning in itself. It's putting yourself into someone else's shoes, using your assumptions base to try and imagine what life is like for them, and therefore being able to tailor your decisions for that. Now, that is an area that computers find very, very difficult, but it's going to become more and more important as we grind out the inefficiencies based on the model and then start talking about some very granular, particularly in finance products. These could be short-term, these could be things. Understanding the customer, which in the end of it is the only place the wealth comes from. You can talk about this wonderful machine that creates money, but in the end of it, somebody's got to pay for it, and that's a human being. Understanding that human being is going to become paramount. So it's going to be about understanding the human, that human connection, and indeed trust, and understanding at this point that trusting one's banker is actually going to become more and more important than ever before. The days of banks moving everything perhaps into the digital realm are possibly not the right direction to be going in. I have a suspicion that the bank manager is going to become very much more important as a role, and the local bank manager as well, because they have to know you. Given the tools we're going to give finance, they can create any product for you in real time. But understanding you and understanding what's right for you is going to be very much a human-centric task still. So that's kind of a quick canter through. It's going to be a fascinating area of change. And I think all of the large finance houses are investing very heavily in this. Everybody's kind of hunting for use cases, hunting for sort of platforms of truth. But as a direction of travel, I think we're quite clear that hyper-personalization, hyper-efficient systems are going to mean more and more emphasis on regulation and the human touch rather than less.
Ed, thank you so much for another fascinating and excellent session. Just so people know, from the articles that Ed has used, they're in the show notes and will be in the show notes if you want to access those. And I think it's really interesting, Ed, that all of the discussions I've been having about AI come back to one thing, which is actually we need more human connection, and we need more trust between humans.
Yeah, it's I think it's becoming paramount that is the differential we will get. Trust becomes even more and more important, not less.
Yeah.
So on the next one we're going to do, which I think is towards the back end of November of these.
It is, yes.
About identity. And I think that's going to be quite an interesting area, because we've left this on a trust and humanity area. Let's talk about what that means in a post-AI world.
Ed, thank you so much for coming on and sharing your expertise. As always, another fascinating session. Thank you.
Fantastic. Catch you all later. Thanks all, folks.